Welcome to the SNN Network Canada virtual event. I'd like to introduce our next presenter, Steve Lovely, CEO of Accru. Steve, the floor is yours.
Great. Thanks for the introduction. Good morning, everyone. This morning I'll spend a good 20 minutes or so doing a bit of a deck flip through our investor deck, and then I'll finish with a 5 to 10 minute Q&A at the end. To start off, the name Accru and where it comes from, it actually comes from, term as an accruing and accruing companies and offerings for the business. So we've been primarily a consolidator as a company over the last 7 years since I've taken over, where we're not only consolidating, within the industry, but we're also consolidating the offerings for our clients. If you think about our vision, it really is to consolidate that marketplace, which and in turn simplifies it for the merchants and obviously improves it all across, the marketing industry, payments, and point-of-sale industries, because that's the area that we dominate in the most. But from a mission perspective, we're a technology-first, not a services-first business. So everything we do is driven around our technology and the tools that we have and we build. And over the last few years, we've expanded from just being a marketing business, which was our initial founding of our business, and we've expanded into 3 solutions. We now have a marketing product, which is a self-serve, data-driven product that runs gift card, loyalty, and promotions for merchants. But we also now resell payment services by reselling Fiserv and Global Payments as an integrated payment solution. And we last year stepped into point of sale. Now we have an operational tool, a financial tool, and a marketing tool for merchants. Our approach is pretty simple in that we're looking to be a strong consolidator, having great financial discipline and understanding how to consolidate, normalize, and integrate businesses into ours. A lot of the businesses we bought have been break-even businesses. Our goal is to take those businesses, reduce costs and create efficiencies and growth in those businesses to generate that 20% EBITDA plus in the business each time. But we do that all with a very innovative approach, where again, it's not just to buy the companies, rip out the cost, and generate cash, even though that's a bit of a byproduct. The real goal is to innovate and further advance those businesses. So through that technology-first approach, we want to take those acquired assets, improve them and scale them further. But how we do a lot of that is integration in the end. We need to integrate those platforms to each other. So when we bought an automotive platform, we have to integrate to our marketing platform, to our payment solutions, but also to other third-party providers that are out there. We really are proud in our ability to consolidate well and effectively, to innovate the technology that we acquire, and then to integrate them all together along with other providers. And we do it across 4 key verticals: petroleum, so gas stations and quick lube; hospitality, table service and quick service restaurants; automotive; and general retail. And in retail, we've extended a bit further. We even got specialized in a vertical like golf. A lot of benefits to our platform. Again, early days, it was a marketing-first platform, providing gift cards and loyalty processing, and then all the marketing that came with that. We then stepped into a lot of data because, for the most part, when you go into our marketing platform or Accru marketing platform, it's providing the merchants a lot of insight and understanding of their business, so they can better create campaigns and drive more people into their business. The payment processing was a necessary service that was needed. So instead of our clients going out and actually getting out to a third party, we're now able to provide that directly ourselves. And finally, that operational tool that kind of ties everything together was the last piece of the puzzle that we're stepping our toe in the water in today. From a financial perspective, we've done well. Even though this slide kind of appears a little bit funny in the slide viewer here, you can sort of see steady year-over-year growth. We had a flat year in 2013 to 2014 as we transitioned myself into the CEO role. And this year, as we've embraced COVID, we'll have a flat year again from 2020 to 2021. But outside of those 2 flat years of managing through, again, a transition from the first CEO to me, and then, in the middle of COVID between 2020 to 2021, we've had consistent and steady growth as a business year over year, which, we feel really confident we're going to continue to sort of maintain and push the business forward. From the EBITDA standpoint, we've had a same trajectory where we've worked our way out of a lot of losses early days into earnings positive as of 2018. So it was a big turning point for the company that took us into an EBITDA positive business. We again continue to grow EBITDA year over year. Our goal as a business is to generate at least a 20% of revenue EBITDA and a 20% growth. So that 40% magic number is what we're striving towards. Earlier this year, we had a large attrition to start the year through the start. So we came off of a record Q4 in 2020 to a really struggling Q1 in the business. I think there was a bit of a delay for us from a COVID perspective. where we saw a big drop off of revenue from a couple key accounts that had pulled back costs. And we also saw a lot of customers that, kept using our platform, but weren't paying us. We kind of gave them deferred payments. Well, in the new year, we got hit with some of those people just choosing not to even pay us. So Q1 was a tough quarter for us this year for the business. So it's the first pullback we've had in a while. But as the year's gone on, as you've seen our financial results, Q2 was better than Q1, and Q3 was better than Q2, and Q4 will be better than Q3, and we continue to sort of compound the business. But we had a kind of a delayed COVID impact on Accru, where it really hit us in Q1 of this year, which affected our revenues. It'll end up being somewhat flat this year from a year-over-year perspective. And you'll see earnings back to where it pulled back a little bit as well because, one thing being obviously the revenue pulled back in Q1, but we also started to do some reinvestment in the business. We started to push for more organic growth earlier this year, and we did a further investment into sales and marketing and engineering. Was it the best timing? Maybe not, as we were facing a lot of attrition. So from a decision standpoint, it probably would have been better to not further invest at that time, but no regrets on further investing in our organic growth, because even though we're an inorganic business first, we certainly want to be an organic business complemented with that inorganic growth. Our organic growth comes from kind of three different ways. Because we're a consolidator, we're buying, various different offerings. The cross-sell and upsell of our business is a big growth area for us. So it's taking our current customers that are gift card only and selling them our digital gift cards, and then selling them promotions and loyalty and our digital marketing, and now our payment solutions and now point of sale. So that cross-sell through our client success team is an important part of our business to kind of create growth. And I talk a little bit about, the cross-sell opportunities in this slide, where we only have, less than 2% of our customers are using more than one solution. So we've got a lot of opportunity to cross-sell and upsell, which is a big part of what we're trying to focus on as a business from an organic standpoint. We do still win lots of new business through two venues, through our product partners, because even though we sell payment and point of sale, a lot of those payment and point of sale providers do refer to us. We have Chinese walls in place to make sure that we're not, if we are referred by one of our clients, we're not looking to displace them. They have their specialties, we have ours. So it allows us to kind of play in position. But then we also have our sales team that's out doing, knocking on doors, direct sales efforts to grow business. And we've actually had one of our stronger organic growth years that we've ever had at Accru. So if it wasn't for the struggling Q1 that we had, we'd have seen a very shiny year. And what has me bullish is that when we look at our results in Q3 and now even Q4 and how that'll keep compounding, it has not only the organic stuff normalizing faster, but the organic stuff really moving. On the technology side of it, it really is about integrating and expanding the offering. 9 years ago when the company started, you've seen, we were a marketing pure play. But the industry, our partners became our competitors. So we had to sort of step into the areas that our competitors were. And as an acquirer, we're buying lots of businesses. Well, when it comes time to kind of refer our acquired customers over to our partners, which partners do you pick? So we were in a bit of a weird spot. So we decided to expand the technology, but into a centralized solution. And the last piece of the puzzle is the geographic nature. We're heavily saturated in Canada. We're, 90% of our revenues are Canadian today. 10% is U.S. So that's a bit of a lift over last year. I think we were 7 or 8% in 2020. So we've had a lift because we did a U.S.-based acquisition, our first ever this year. We were excited to kind of go down to the U.S. to actually get a presence, get a customer base down there. So it's our first ever acquisition that we did in June into the automotive space and on the point of sale space as well. And so that expansion across North America is a big thing for us. When we look at some of our big direct competitors, like the GiveX's of the world that just went public, they're heavily international. They actually have more revenue internationally than even North America-wise. So our first step is let's get North America, under wraps and get a lot of expansion into areas like the U.S. And then go international after that. I'd mentioned our focus on acquisitions. Since I've taken over 7 years ago, we've done 11 acquisitions to date, ranging anywhere from 1.5 to 2.5 times revenue. And really, the devil's in the detail of what we paid and when we paid it. But early days was a lot of stock issuing because that's all that we had access to. But as you can sort of see through the last 5 deals now, it's been all cash focused. So the model of Accru is to, obviously to buy these businesses and reduce costs. It's also to generate cash in the business to then buy more businesses. So yes, there'll be some reinvestment back into the company. There'll be an acquisition, and then down the road, if there is an acquisition, there's probably a share buyback discussion that will happen to help grow the business that way. But for our business, fundamentally to generate cash to acquire more assets later on in the business. From an integration time standpoint, it really is important for us to kind of integrate all these assets. You can sort of see the last few deals are still in normalization mode. So really important that we stretch out our deals, that they're not layered on top of each other too much, so it's not too disruptive for the business. But in every case, it's making sure that we're expanding strategically in a way that's advancing the business, not just the revenues, while continuing that sales funnel of M&A opportunity where we've had always a 20-plus opportunity over $60 million of annual revenue that we've always had kind of in our funnel, and that is our current funnel even today. So talking about our inorganic go-forward strategy, really the goal is to buy one or two per year. We've only done one in this year. We have one in June. We're not doing a second one but the close of the year already into December. The next acquisition for us will be in the first half of 2022. What will depend on that is a number of factors. We've always got deals in the pipeline that make sense for our business and for even the seller. But a number of factors play into things. Today our access to capital is minimal, meaning that we've got some cash in the bank and we've got a line of credit that we can leverage to acquire the next a smaller deal. However, if share price appreciation happens, we have $4.5 million of warrants at 18 cents. So if our share price ends up back in the 20s, perhaps what we do in the first half of the year is a larger acquisition because we have access to that capital. So our share price actually plays a bit of a factor into the next deal that we do because of access to capital for the business. And so we're looking at it saying, do we use our current capital and acquire a smaller business, $1 million, $2 million business, or is the stock price going to be in the 20s where it makes sense to pull on the warrant holders? And there's really just 4 of them that hold those warrants at $4.5 million to put in the business to do a much larger acquisition. But for us, we want to make sure they're accretive. We're no longer just buying customers. We want tech and talent. The customers are great, but technology and talent are even more paramount to Accrue now. We want to be normalizing within 12 months where we not only get them in our business from a cost management perspective and leadership perspective, but also to know that we can grow it. And that 40% of contributing EBITDA is really important. So I talk about 2020. We want to have 20% contributing and 20% growth in the business. But everything we acquire, we want to get 40% EBITDA out of it. So maintain the 20% at all times, but then we take the other 20 and reinvest in other areas of the business. And the last thing to know is on the acquisition side of it is that we are going to be doubling down in these areas. We found a sweet spot in the marketplace for these small to mid-sized acquisitions that are smaller than us. So anything that's smaller than Accrue is what we're looking to buy. And it's really doubling down on these 3 corners of our business. From a financial highlights standpoint, our retention rates are great. They were less than 5% going into COVID. And in this year, the first half of this year, it went up to as high as 10. So again, Q1 was a struggle quarter for us, the business. We had massive attrition for our business for what we think is a massive, but it's normalized back. We had a 5% attrition rate in Q3, which is encouraging. So we have an overall attrition year to date of 8% now. And we're seeing a similar trend in Q4 that we saw in Q3 from a number of customers' perspective. Our gross margins are extremely high because it's a software business. Our percentage of recurring to one-time revenue is extremely high. Our CAGRs of both EBIT and revenue have continued to grow. In Q3, our EBIT as a percentage of revenue was 11%. We're going to continue to keep improving on that quarter after quarter. We do have some cash in the bank and a line of credit. And the big thing being that we're buying businesses and we know how to do it. This isn't our first time doing it, so there's been a bit of a rinse and repeat model that we've been figuring out how to do. So several major milestones. The business started in 2012. I was brought in as the VP of Sales and Marketing to help the business. In 2013, we had to rebuild the commercial model and change the tech. It's in 2014 that I took over and did a 10-to-1 share consolidation to kind of really restart the whole company. So 2015 was really the rebirthing of Accrue, where we did our first acquisition in both the gift card space and the automotive space, pivoted the business to be an acquisition growth company first and organic growth company second, and driving through partnership. And as you can sort of see, we've continued down that acquisition path year after year after year. Our business model consists of 4 key things. We have a one-time revenue that comes through setup fees. So depending on the platform, if you're a marketing platform, one of our point-of-sale platforms, there's a one-time setup fee. Our clients then pay a monthly subscription fee for our software. Again, whether it's our marketing platform or one of our point-of-sale platforms, they'll then pay us that monthly fee, and it ranges. The current average is about $80 per location per month that we're getting between our software platforms. And then we've got variable subscription revenue that comes from like payment commissions and residuals and point of sale residuals. And then there's just other one-time revenue that comes out that we call product revenue in our financial statement. But as a whole, we're making on average about $98 per location per month. So our goal is to keep driving that number larger. Much better to have a higher revenue per location because your cost model is better. Having people with similar revenues as us, but 3 times the customers is not a better business model because you have more support costs and more work to be done. We like that we may have a little bit lower location count, but we have peers out there in the marketplace that have 2-3 times the customer locations, but that means their support costs are that much heavier. So we like the higher revenue per location model that we're driving towards. So our market positioning, initially, again, we were a gift loyalty company. That's what we were known as back in 2012 when the business started. We paid in that one piece of the pie. But today, as the business has evolved, we're still known as a marketing business, our loyalty marketing product that we have. But now we're complementing it with payment and point of sale. What you're going to see in the future, though, is a pivot once again, where instead of just being complemented by payment and point of sale, I believe that we're going to be building a point of sale business that'll be the heart of our business in the future. That operational tool that drives businesses. We first stepped into it with niches like automotive and golf, and we have other areas that we're looking at like hospitality into the near future. And so, we're looking at ways to kind of advance our business operationally first, payment and marketing second. So a bit of a pivot to the business that's in front of us. And we think that holistic view where we own the operational tool first and have great payment and marketing tools second will really help us, and we'll differentiate through that. We'll differentiate through low cost, transparent payment offerings, but a very robust, what we're known for marketing solution that'll differentiate us from all the other point of sale companies that are out there. So again, our strategy has 3 pieces to it. Our point of sale business will eventually become the middle of our business with payment and marketing side of it, but we're going to continue to address all 4 verticals: our petroleum, hospitality, automotive, and retail verticals. Addressable market's large. If you just look at where we have POS today, we have a golf course point of sale. We've got 163 clients, but there's over 20,000 of them in North America alone. The automotive side as well. On just the DMS side of it, we have 151 dealer management system customers. That's that POS tool. But there's 145,000, so a massive addressable market there. Then in payment and marketing, large addressable market. So we've got lots of runway still to run after, where we've done well in a few verticals, but like extremely large runway in front of us. This is our organic growth slide from 2020. I'm going to update this in January as to how we did in 2021, and you'll see, on the right-hand side there that we did do quite a bit of organic growth and inorganic growth into the business. Inorganically this year, it was all saturated into the U.S. because the only acquisition we did this year was a U.S.-based acquisition. But organically, it's been across both Canada and the U.S. Our clients are made up of large merchants, medium size, and small size. Where our large merchants pretty much all came to us through acquisition. Through our acquired assets, we've acquired pretty much all of those. What we do well, where we win organically, where we're strong is that mid-sized merchant. Those multi-location businesses, those POS payment and marketing utilized clients of ours are really our sweet spot. But we also do really well in the small size market because we have this self-serve platform and it's a very affordable technology. So where our strengths are that medium and small size business, we just have some large clients because we've done so through acquisition. But they're harder to support. They're more customized in what they need us to do. So we prefer our focus on the mid to small business. Lots of partnerships in our space. It's a very fragmented space. So you need to partner and integrate with lots of different providers out there, and we do so. Lots of direct and indirect competitors, from gift and loyalty in the marketing and mobile space and payments and point of sale. So it's a busy ecosystem, hence the need for why there's so much consolidation happening. Lots of players out there, but not only is there lots of players within each area, now all these areas are converging and competing. So that's where you're seeing, acquisition and merger across these different verticals. We differentiate in a number of different ways. Our focus as a consolidator across all merchant types. Some of our competitors are very focused on one vertical versus another. Or they've been a pure organic play. We've been very balanced, both in organic versus inorganic, and balanced across multiple verticals. Makes more complexity and slower growth for us that way because we've been so diversified. But it's had us a much more stable, safe business. And as long as we continue to have this operational and financial diligence to make sure that we always stay profitable and always keep moving things forward, it'll help differentiate us. our breadth of offering across multiple platforms. We've made sure things are affordable. And from a public currency standpoint, we're starting to see a lot of people in our ecosystem starting to go public or becoming public. But there was a time when felt like it was just us. So our public currency was an asset to us, and still is, as we look to do deals where taking public paper versus private paper is much more appealing to a seller. And then obviously, ideally, liquidity and being able to sort of draw capital for M&A purposes. But then when I think about on the other side of the ledger, our market leadership and the things that we're doing in data, our digital marketing and mobile work that we're doing, and then fundamentally, we've had strong revenue and EBITDA growth, and we're going to continue to be focused there. We've got a huge percentage of recurring revenue, and our organic CAC to LTV is great. Our lifetime value is estimated at about $9,000 a location, costs about $1,200 to acquire. So we're doing really well at that $100 a month, but we kind of break even in the first year, and we make money continuously in subsequent years. And then the valuation today, the stock has really pulled back at Accrue. We were as high as 38 cents back in March. It's pulled back to like 11, 12 cents recently, and has us at a 2 times revenue or 10 times forward EBITDA business right now. So we believe it's very attractive from a valuation standpoint. Our share structure and ownership is made up of, we have 150 million shares issued. We have some options and warrants that are outstanding. Those warrants are at 18 cents. Puts us at a market cap of 14 million, but it's heavily or tightly held, across management and traditional insiders. From the executive team, there's myself and our new CFO, our senior leadership team across the business, and then there's our board. So I'll stop there and answer any questions. I see that there's a question here. Let me open this up. What is your vision for the company in the next 12 months? For us, it's really, I showed a lot of the different assets that we've acquired over the past few years, and you saw, to be determined about integration. Really important for Accrue to take these acquired assets, the last few that we purchased, and finally fully normalize them, which for us means, again, not just, taking over the team and replacing talent and getting some costs out. It's advancing the technology. So how do we start scaling for growth in each of these acquired areas that we've done? So it's getting rid of there's some technical debt that we've assumed in the business that we want to kind of remove from the business, which is an important thing. But also just to start testing growth in each of these markets, in each of these areas. Because usually at that 12-month mark, we want to know how far we can sort of push it and move the business. We're also going to put a huge focus on the earnings again, where we want to make sure that we're generating that 20% EBITDA as a percentage of revenue at all times. It allows us, our model with regard to acquisitions to make sense because of, what buy is always at, 4 to 5 times max return on invested capital is what we're always looking for as a business. So that diligence of the 20% EBITDA plus is important, but also that 20% growth in a business so we get that magic number of 40 that we're striving towards. So there's that financial discipline that we want to be really making sure that the business has intact. We want to make sure that we've got everything normalized from a technical debt perspective, so clear up a bit of the past work, which we're diligently working through. Begin scaling some of these acquired assets, but then do the next acquisition. The next acquisition that's in front of us, we're always working on some, but there's 2 or 3 that are very close to being ready for something to happen for us. So it's being in a position, the business is in a position to take on the next acquisition, normalize it, stabilize it, and then expand it from there. Any other questions from the group? Okay, it looks like we have 5 minutes of spared room here, so I guess we can cut off there, Kate.
That concludes today's presentation, and thank you for tuning in.